Gold just crashed 13% in 48 hours, silver down 15%. The largest precious metals collapse since March 2020, not over weeks, over 48 hours. From $5,600 to $4,800 for gold. From record highs to panic selling in 2 trading sessions. And the trigger wasn't economic data, wasn't inflation numbers, wasn't recession fears. It was a single name announced by President Trump, Kevin Warsh, the next Federal Reserve Chair nominee. A name that represents everything gold investors feared most: monetary discipline, strong dollar policy, and the death of the currency debasement trade that drove metals to records. The announcement hit markets February 4th, 2026. Markets processed the implications overnight. February 5th, metals started falling as investors absorbed the meaning. February 6th today, the crash accelerated into full panic mode. This isn't normal volatility. This isn't profit-taking after a long rally. This is the debasement trade dying in real time as market participants recognize the paradigm shift. The entire thesis that drove gold and silver to records, central bank incompetence, currency debasement, inflation, hedging, evaporated with one nomination announcement. Let me show you who Kevin Warsh is, why his nomination crashed metals, what this means for the dollar, and why billionaires positioned for this moment. Start with the timeline because sequence reveals everything. Late 2025, rumors circulated about Powell replacement. Market expected dovish nominee, someone who would facilitate lower rates to support deficit spending, someone aligned with easy money policy. Instead, Trump nominated Kevin Warsh. Who is Warsh? Former Fed governor. Served 2006-2011. Best known for his 2010 dissent against QE2, quantitative easing round 2. While the Fed was printing money to stimulate the economy, Warsh voted no. He argued, QE creates asset bubbles without generating real growth. He warned about inflation risks. He advocated for monetary normalization. Hawkish, hard money, dollar strength advocate. February 4th, nomination announced. Market reaction instant. The metals market, which had been pricing in continued currency debasement, suddenly faced the opposite. A Fed chair who opposes money printing, who supports strong dollar policy, who prioritizes price stability over growth. The entire foundation of the gold and silver rally, fear of currency debasement, collapsed. February 5th, selling began. Gold fell from $5,400 to $5,100. Silver dropped 10%. Mining stocks crashed. Newmont Corporation down 8%. Barrick Gold down 7%. The market was repricing the probability that Fed policy under Warsh would be fundamentally different than under Powell. February 6th today, the crash accelerated. Gold touched $4,800. Down 13% from highs. Silver down 15%. This isn't profit-taking. This is panic exit from the debasement trade. Investors who bought metals as inflation hedges, as dollar debasement insurance, as protection against central bank incompetence, are liquidating. Because Warsh represents the opposite. Competent monetary policy, dollar strength, anti-inflation. Now let me show you what the debasement trade was, because understanding what died helps you see why. For the past 3 years, investors piled into gold and silver betting on currency debasement. The logic was simple. Governments running massive deficits, central banks printing money to finance those deficits, inflation accelerating, real interest rates negative. The rational response, buy hard assets that can't be printed. Gold, silver, real estate, commodities. This trade worked spectacularly. Gold doubled from $2,000 to $4,000, then to $5,600. Silver went from $25 to $50. Mining stocks soared. Bitcoin rallied on similar logic. Anything scarce, anything that can't be debased, attracted capital fleeing fiat currencies. But the trade required one condition: central banks continuing incompetent policy, continuing to prioritize growth over stability, continuing to print money despite inflation, continuing to debase currencies. The debasement trade was a bet on central bank failure. And for 3 years, that bet paid off. Warsh's nomination breaks that condition. If Warsh becomes Fed chair, policy changes. No more money printing to finance deficits. No more prioritizing growth over price stability. No more tolerating high inflation. Instead, tight money, strong dollar, monetary discipline. The debasement trade dies because the Fed stops debasing. Now let me show you Warsh's actual policy positions because his 2010 dissent reveals his thinking. When the Fed launched QE2 in 2010, buying $600 billion in treasury bonds, Warsh dissented. His argument: QE inflates asset prices without creating real economic growth. It benefits Wall Street while hurting Main Street. It creates moral hazard by bailing out bad decisions. It risks future inflation. It weakens the dollar. Warsh argued for allowing markets to clear naturally. Let asset prices fall to sustainable levels. Let bad investments fail. Let interest rates reflect real supply and demand for capital. Stop manipulating markets through money printing. This is hard money philosophy. Austrian economics. The opposite of Powell's data-dependent dovish approach. If Warsh implements these views as Fed chair, consequences are massive. First, no more QE. The Fed stops buying assets. Balance sheet reduction accelerates. The $7 trillion balance sheet built during COVID gets unwound faster. That removes liquidity from markets. Asset prices fall, especially assets that benefited most from QE, growth stocks, real estate, gold, silver. Second, higher real interest rates. Warsh won't tolerate negative real rates. If inflation is 3%, rates go above 3%. Probably 4 to 5%. That makes holding non-yielding assets like gold and silver expensive. The opportunity cost of not holding treasury bonds yielding 5% becomes too high. Capital flows from metals to bonds. Third, strong dollar policy. Warsh supports dollar strength. He'll tighten monetary conditions even if it strengthens the dollar. That's deflationary for commodities priced in dollars. If the dollar strengthens 10%, gold priced in dollars falls proportionally just to maintain the same real value. But the market is pricing in more than that. The market is pricing in gold falling because the debasement narrative dies. This is why metals crashed 13 to 15% in 48 hours. The market is repricing from a world of currency debasement to a world of monetary discipline. And in that new world, gold and silver lose their primary investment thesis. Now let me show you who's getting destroyed. Mining companies. Newmont Corporation, largest gold miner, market cap decimated. Stock fell 12% as gold prices collapsed. Barrick Gold down 10%. Smaller miners down 15-20%. These companies are leveraged to gold prices. When gold falls 13%, mining stocks fall more. The entire sector is being repriced for lower gold prices sustained over years. Gold ETFs seeing massive outflows. Investors liquidating gold holdings. GLD, largest gold ETF, down 11% in 2 days. Outflows exceeding $2 billion. This is forced selling. Funds that bought gold as inflation hedge don't need it anymore if Warsh prevents inflation. Silver ETFs, similar. SLV down 14%. Outflows accelerating. But here's what's interesting. Not everyone is selling. Central banks still buying, China still accumulating, Russia still stockpiling. Why? Because they're not betting on US inflation. They're betting on dollar system decline. They're accumulating gold for monetary system transition. That buying provides a floor. But retail investors don't care about monetary system transition. They care about returns. And returns in gold just evaporated. Now let me show you what's working. Treasury bonds, the dollar. As metals crash, bonds rally. The 10-year Treasury yield fell from 4.29% to 4.21%. That's investors buying bonds, expecting Warsh to support them. The dollar strengthened against major currencies. Dollar index up 2% in 48 hours. Classic flight to quality during uncertainty. And look at what billionaires did. Warren Buffett holding $325 billion cash. Not gold, not Bitcoin, cash. Treasury bills yielding 5%. If Warsh implements hawkish policy, those treasury bills become more attractive. Real rates go positive, Buffett wins. Bill Gates reduced equity exposure, bought boring defensive stocks, not gold miners, not commodity producers, utilities, railroads, assets that work in a strong dollar environment. Gates positioned for exactly this scenario. Jeff Bezos liquidated $8.5 billion. Converted to cash, not gold, cash. If Warsh strengthens the dollar, cash appreciates relative to everything else. Bezos wins. The pattern is clear. Billionaires positioned for strong dollar policy. They didn't buy gold at $5,600. They held cash. They bought dollar-denominated assets. They bet on monetary discipline returning. Warsh's nomination proves them right. Now let me show you the political dynamic because confirmation matters. Powell's term ends May 2026, but he retains his board seat until 2028. If Warsh is confirmed, he chairs the Fed while Powell sits on the board. Awkward, potentially conflicting. Powell might resist Warsh's hawkish policies. The market is pricing in this tension. Senate confirmation hearings are critical. If Warsh softens his positions, says he'll be data dependent, implies he'll be more dovish, metals could rebound. But if he doubles down on hard money views, metals fall further. The market is watching every word. Trump's motivation matters. Why nominate Warsh? Why choose a hawk when Trump historically prefers low rates? Possible answer, Trump wants strong dollar to combat inflation, wants to restore dollar credibility internationally, wants to show fiscal discipline. Warsh achieves these goals. But it means sacrificing asset price appreciation, means accepting market correction. That's a tough political choice. Now let me show you what happens next because the Warsh shock isn't over. If Warsh is confirmed, policy changes in May 2026. The Fed pivots from dovish to hawkish immediately, balance sheet reduction accelerates, rate cuts stop, possibly rate hikes if inflation persists. Markets reprice everything. Gold could fall to $4,000, silver to 35s, mining stocks down another 20-30%. The entire debasement trade unwinds over months. Trillions in capital that flowed into hard assets flows back to dollar assets, bonds, cash, dollar-denominated securities. But there's a risk. If Warsh tightens too much, he crashes the economy. Recession follows. Then metals rally on different logic. Recession hedge, not inflation hedge. The market has to handicap this probability. How hawkish will Warsh be? Will he prioritize fighting inflation even at cost of recession? Or will he moderate when growth slows? Nobody knows. That uncertainty creates volatility. Now let me show you the international implications, because the Warsh shock affects global markets. Strong dollar hurts emerging markets. Countries with dollar-denominated debt face higher servicing costs. Capital flows out of emerging markets back to US. That creates crises. Turkey, Argentina, countries with weak currencies and high debt face pressure. China, watching closely. They've been accumulating gold to diversify from dollars. Warsh nomination reinforces their strategy. But strong dollar makes Chinese exports more competitive. That helps their economy. Complex dynamics. Europe affected. ECB policy diverges from Fed. If Fed tightens while ECB stays loose, euro weakens. That's inflationary for Europe. Creates policy challenges. What should you do? First, recognize the debasement trade is over. If you're holding gold and silver as inflation hedges, reassess. Warsh represents anti-inflation policy. The thesis for owning metals just changed. Doesn't mean sell everything, but reduce exposure. Second, increase dollar exposure. Cash. Treasury bonds. If Warsh implements hawkish policy, dollar strengthens. Real rates go positive. Bonds become attractive again. Position accordingly. Third, avoid mining stocks. They're leveraged short positions on Warsh's confirmation. If he's confirmed and implements hard money policy, mining stocks fall further. Don't try to catch falling knives. Fourth, watch confirmation hearings. If Warsh softens positions, metals rebound. If he doubles down, metals fall more. The next 3 to 4 months determine whether this is 13% correction or 40% bear market. Fifth, recognize billionaires positioned for this. They didn't buy gold at $5,600. They held cash. They positioned for strong dollar. Follow their lead. The Warsh shock crashed gold 13% and silver 15% in 48 hours. The debasement trade is dying. The Fed is transitioning from currency debasement to monetary discipline, from weak dollar to strong dollar, from inflation tolerance to inflation fighting, and markets are repricing everything in real time. The billionaires saw this coming. They positioned in cash. They avoided gold and silver at highs. They bet on dollar strength. Warsh's nomination proves them right. The question is whether you'll adjust your positioning or whether you'll hold metals hoping the trade reverses, because if Warsh is confirmed and implements his views, the reversal isn't coming. The debasement trade is dead. The strong dollar era is beginning. And the billionaires are already positioned for it.